Hit it.
It's Friday, December 13th, 2024, episode 254. I'm Patrick Suresna.
And I'm not Kevin Muir.
Exactly, Danny. But Kevin needed the week off, but he'll be back for our next episode like normal. This week, PineCone Macro's Chase Taylor joins us. We're going to talk about this crazy bullishness in the markets, and more importantly, how he thinks it's all going to end. Then Chase will stick around to judge how sharp my crayons are in the Talking Charts segment. So, Danny, we dropped the ball this week so bad. I have no beers.
Me neither.
I literally looked in the fridge and I have Portuguese wine and non-alcoholic beers, neither being in any way acceptable to put onto the show. So we're going dry.
I think I think that's not a bad idea. Considering Christmas is just around the corner, I think we could probably use a break.
There you go. All right. Listen, we've had so much success with these market huddle Q&As that we've been doing live. Last one was with Cuppy, and so we're going to do it again. So what's the story?
Yeah, so we're going to do another Q&A. We're going to do this time with Paul Craik and Rupert Mitchell, who's going to be joining us from Australia. That's next week, next Wednesday, which I think is the 18th of December. And we're going to be doing it at 3 p.m. Eastern time. So if you check out the Twitter feed, there's a link there for you guys to click and join.
That's right after the Fed meeting. That's perfect timing.
Bang on.
Anyway, there you go. So listen, Danny, I'm going to let you read the disclaimer, buddy.
I'm going to try. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include AI asset anxiety, supply chain seizure, and geopolitical gyrations.
I've had plenty of those. All right, let's get Chase on. So joining us again is one of my favorites, PineCone Macro's Chase Taylor. Great to have you back on the show, buddy.
Great as always to be back. Thanks for having me.
All right. So listen, I want to dive in because we are just seeing crazy markets. The fact that we obviously had this big reaction to the Republican victory, and then it just transitioned into this huge Mag 7 rip on the upside. There's so many things to talk about. So you wrote this piece, The Emerald, Bear Signal, and I thought it was great. We'll reference it throughout this session. But first of all, just at a high level, what's your take on all of this? What's your thinking? And if there's any charts you want me to pull up here, just tell me which one.
Yeah. So you said the markets are crazy, and I disagree. I think the fart coins fundamentals are pretty legit. So,
Hey, listen, hot air rises, buddy. It's
the piece you're referencing is honestly just came about because there was like this 2-week period, and like you said, this started with the election. There's like a 2-week period where just in my day-to-day, like looking at a bunch of charts, like I just kept hitting like things that were like warning signs to me. So for a few days in a row, it's because I send out a daily product. For a few days in a row, like I had like, I don't know, like half a dozen charts that I said warning on. And then it just kind of hit me after that reached probably 25 of those. Like, oh, I have to put all these together and like actually kind of think about it, talk about it. So that was what led to this piece, which is no kidding, just a whole bunch of charts that show a very stretched sentiment and positioning. Like at the end of the day, just that stuff just all went kind of nuts within a month.
All right, Chase, I want to get to the charts that you have prepared, and we can take a look at it. But the one thing I wanted to really first just talk about is that we started a few weeks ago or a month ago with, or even 2 months ago, when the market started to favor the idea that there was going to be a Republican victory. And then suddenly all of the Republican kind of victory trades started to work. We saw obviously financials doing very well, energies were doing well, consumer discretionaries were doing very well. All of these types of trades were ripping. And then, of course, as soon as the Republicans won, there was that explosive further kind of boost in these, including in small caps and all of these things. But that pivoted just a couple of weeks ago. Like, what is it that, like, is it that what is it that in your mind happened that made this kind of transition pivot in it, just that started all of this Mag 7 ripping?
So I have a pet theory. I have no idea if it's legit or not, but my pet theory is I think you kind of hit a like escape velocity for the narrative that AI is going to go from a focus on training to a focus on post training and inference, which at the end of the day has dramatic consequences for capex and for who wins, in medium term. Not great for Nvidia, but it is great for the hyperscalers, which is essentially the Mag 7, because they won't have to do all that insane capex to, just keep doubling the amount of chips they use and the amount of power they use and all that stuff like ad infinitum. So if you think about where their earnings and margins are in like 3 years, that would be significantly better. And then obviously you add into that the passive inflows still hitting Mag 7 fine, and then all of the active people, it's mid-December, so a lot of people aren't going to be at their desk hitting the buy button on anything. But the machines that have to buy the index will be. So I think it's a combo of those two forces kind of all together.
Yeah, but it's more distinct the fact that we saw all those Republican victory trades actually substantially give back their gains. Like the financials are tanking, the energy stocks are tanking, and so it's like literally they became a sector rotation. But I'll tell you what, let's save that. We'll talk about some of that when we pull up some charts. So let's start off here. You have the conference board consumer confidence numbers here. What is your take on this here?
Yeah, so Conference Board has been asking people about their expectation for stock prices to go up since 1987. And 2 months ago, it hit a new all-time high. And I posted the chart, talked about it, thought like, this is a big deal, this is crazy. And then from that all-time high, it like gapped up like another 4 points. And on this thing, 4 points is a lot. That's like 8% essentially. So you went from an all-time high to a wild all-time high on something that goes back, almost 40 years. And you see this in other data where it shows like people's expectations for how much their portfolio will go up in a given year. Like those numbers just keep going higher and higher. So just one of those things like, hey, like regular people are incredibly bullish on the stock market.
And it's amazing because it really is being driven by their concentration in all of the kind of bubblish things that have been the most speculative.
Yeah, like Mag 7 is the second biggest stock market on earth. So,
there you go.
And as we just saw, the Interactive Brokers guy, like who he deleted the tweet, but he said 70% of their all their flows are just Mag 7 stocks. So that's pretty intense.
That's insane. All right, so here you were referencing what Buffett's doing.
Yeah. And this is fun because like I made fun of this, I don't know, a couple months ago or something, when everyone's like, oh, he's selling Apple. What does he know? And like, he's got a bunch of cash. And no one looked and was like, yeah, but like a cash is a percentage of his whole balance sheet. Still not like at an all-time high. So whatever. And then like a couple months later, now it is essentially at an all-time high. So not only is he raising cash, but not putting it back into anything. And I don't think he's like, he knows something and he's a genius like on market timing or anything. I'm not saying that, but at the end of the day, the fact that he can't find anything to buy, like it does say something. And he's famous for the, be fearful when others be quote. And right now everyone's greedy and he's fearful. So it's worth noting.
Yeah. It's I mean, this is a record cash level for him, at least from this chart, right? And that's that could tell a lot. And so here you are looking at the long short spread.
Yeah. So a lot of people I've noticed, and speaking of that Interactive Brokers tweet, he mentioned that margin loans were spiking. But what I will say is like, I notice a lot of people still look at margin levels as a way to like look for froth. And I literally don't pay attention to it. It's 2024. People use ETFs and levered ETFs. So what I do like to watch is to see when people go nuts on levered long ETFs or levered short ETFs. It tends to be a reasonable market timing, force multiplier. And I think this has gotten worse since this chart, because this chart's like a month old now. But the ratio of levered long versus leveraged short is like you're essentially back to the 2021 peak. I think above it now. And I want to say this may have gotten up to like 14-1 ratio. So everyone's levered, in the levered long ETFs. And it's
Yeah.
worse than that because some of those aren't levered long, S&P. Like a lot of them are levered long, like MSCR or, uh, Bitcoin or like way more volatile stuff. So not only are people levered, they're leveraged to volatility.
So the question I have for you is one that I've heard some people like David Rosenberg kind of reference. It's like, he's obviously it's the suggestion that, look, these markets are stupid, the valuations are stupid, you can't justify where the market is, but it's the only thing that's working, and the momentum's there, and bubbles last much longer than most people expect. And so even though we're seeing these extremes, is there something that makes you feel that we're closer to the kind of like blow off, or is this something that you think can perpetuate still further?
I don't think you can go too much further without having a pretty decent pullback. At least like 5 to 15% type, just burn off some of the craziness. Um, but do I think you can have the 7% pullback that takes some of the crazy out and then just march right back on higher? I do. Not really my base case. I think after having two insanely good years, the chances of having another one they tend to go down. But I also have written in Emerald about a 1998 analog that basically taps into the Fed cutting into strength, and it's pretty clear to me at least for now we're absolutely cutting into strength. And whenever we cut into strength back in '98, that led to the market going up kind of 1% a day for a while. So it's not crazy to have like another great year given that cutting into
Yeah.
strength part.
Yeah. So here you have trash is running. So what's this one telling us?
Yeah, it's US mega cap tech versus profitless tech, and this is just a way to show. And this has bounced a tiny bit since, but even with Mag 7 doing what it's doing, a lot of these profitless tech companies, there's like a lot of junk in like fintech and stuff like that, that is running even more.
Right.
And whenever profitless tech just goes kind of crazy, like it's a pretty big sign. You go back to 2020, and that stuff just went straight up versus mega cap, and it just started running uh, really significantly since the election, and that was one of the things that just set off alarm bells for me.
Right, right. And let's talk sentiment, because I think the election results just added additional fuel to a sentiment that was already super bullish after an amazing 2-year run. So what's your interpretation here of this?
Yeah, and the chart we have up is Goldman Sachs's like sentiment indicator. Like and a few different investment banks have some good. I like to look at all of them individually, but some of them have built like indexes that smash together like 15 sentiment indicators or whatever, and then you baseline it against history. So this is one that and a lot of people use this one, but yeah, after the election, it blew out to the highest it had been in a couple of years. And there's they have a longer term one that you could see that it's rarely been this high in the last like 15-20 years. So just a good way to show, if you take a lot of different sentiment readings and put them together, that you're basically more or less as high as you ever get.
It's an interesting sentiment thing is I always wait until I have friends and family members that are not involved in the stock market start to call me. And I got in the last couple of weeks 3 phone calls. It usually takes 3 for me to get nervous, where they're like, "Oh, I'm really bullish. I think things will be great because of this, and should I go along the market?" And it's like, now I've got it's like that whole, when the shoe shine boy or the taxi driver is giving you stock picks, that say you should be nervous. And I use the friends and family indicator personally for that. But that sentiment is definitely there. But let's talk about futures positioning, because you find this also somewhat interesting here.
Yeah, and I shared another another one of these from I can't remember which, another one of the investment banks that was showing like the percentile, and at last check it was 98th percentile for funds being long equity futures. So yeah, the positioning in the futures market for funds, yeah, 98th percentile. And this chart from Deutsche Bank shows it going back to 2021, and you're even higher. And this is as a percent of open interest, but and you're even higher than you were back in 2021 as far as professionals out in the future market.
That's insane, and but we can't talk about sentiment without talking about what the hell's going on in shitcoin and the rest of the crypto space. But like these charts look insane.
Yep, and again, more have come out since we had. So we have the crypto fear and greed index is basically pegged out at the highest it gets to open interest and Bitcoin futures, Ethereum futures, and then Bank of America does the flow data for crypto, and that chart is just kind of breathtaking, just straight up, and more or less same thing since the election. So yeah, everyone's all in on crypto and bullish, like that, full stop.
The interesting part is that a lot of people initially thought the securitization of crypto and bringing it into the financial space, creating futures, derivatives, ETFs, and all of these things was obviously going to be super bullish, and it was, because it gave access to people who wouldn't go and open a Bitcoin wallet or like a crypto wallet to get access to the space, but it introduces traditional leverage, particularly margining and all the other aspects, and dealers having to construct hedges based on all their exposures, which I think exacerbates volatility. And the question that on my mind, and I'd love to get your opinion on it, is does this increase the likelihood that crypto will have almost a direct correlation to all risk assets? Like when we finally reach a correction, that this is literally going to be the epicenter of where all assets are correcting, but cryptos can't really diverge from it, and they'll be stuck correlating.
Yeah, at the end of the day, yes. I mean, and Bitcoin or crypto in general is sort of the ultimate liquidity proxy, and which is an interesting point that I'll talk about a little bit, and that is if you look at global liquidity, say from like cross-border capital, if you look at just Fed liquidity, as you can calculate with 3 or 4 inputs,
Yeah.
those actually aren't doing well. They've been kind of flat down lately. I know like some people have like a bit of a net excess liquidity model that is showing it going up. That one has been correlating better because since the election, you're trading like you have like a liquidity waterfall like hitting the market, despite the fact that most measures are showing no. In fact, it's kind of pulling back. That's an interesting kind of juxtaposition. A thing to keep an eye on, in the coming weeks. For me, it's just another warning that there isn't actually the liquidity support for the performance we're seeing in things like crypto. But crypto obviously is the ultimate, the ultimate animal spirits like dream catcher, and we have that stuff in spades, so it makes sense that it's going nuts. And I think it was pretty undervalued versus gold, versus liquidity there for a good chunk of this year, and it just took it all back and then some, right after the election.
Right. And so let's talk about options, and because this is obviously my wheelhouse, but you're talking here about the options volumes in the different categories. What are you seeing here?
Yeah, the volumes have gone straight up since the pandemic, stayed really, really high. But then obviously the put call ratio has been kind of making headlines lately for no one wanting protection anymore, other than right tail protection. One of the charts is the Deutsche Bank chart showing the net bullish opened option strategies. And what I like about it is they break it out by large traders, like kind of normal size traders, and then small traders. And the one just totally hockey sticking is that small traders subset, less than 10 contracts. So yeah, between total volumes, put call ratios, and then small traders, getting bullish in options, is just another one of those things that stands out as a warning sign.
When it comes to put call ratios, my pushback on the traditional way many analysts kind of approach it is the fact that, well, the demand for puts may not actually be going down, but it might actually be the demand for call options, because it's a ratio is just skyrocketing, and the
Yep.
demand for the hedging could actually be quite static. But when a lot of very smart people know it's a bubble, they often will turn to buying upside gamma on the markets, so that they have
Yeah.
definable downside during bubbles, and they pass that risk over to dealers to hedge. And so, the fact that the put call ratios are this way, I don't think it's that so much about people not wanting to hedge, but rather about just so many people being so educated on calls that there's more and more people using this way to continue to participate in the this idea that bubbles keep going, and that's their way of getting that upside participation. So, but it is definitely at extreme levels for sure. You here are talking about the leveraged ETF bets. What's going on here?
Yeah, there's just a chart of the dollar value of single stock ETFs, which ripped to a new high. And these, pretty much every week you see new ones coming out. So if you can think of a high flying stock, especially if it's trashy, it will probably have an ETF just to track it. So,
Yeah.
and that's one of the things that just absolutely went straight up since the election, is that those single stock ETF volumes. And that, I don't know, to me that's another warning sign, especially when they come from the Palantirs and MSCRs and things like that of the world.
Absolutely. And the interesting part is that there's so many people that over the last few years, like, this has been the same trade's been working. And so they simply are persistently going back to the same things over and over again, betting that this will persist indefinitely. But that in itself creates this thing where it takes certain assets to the stratosphere, to levels that are just absurd, but simply everyone's forced to participate, because when you're a value investor and you're buying the cheap shit out there, it hasn't moved, and you're losing assets under management. Everyone says, well, you clearly don't know how to pick stocks because you're not making money like the indexes, or like these guys that are just betting on the absurdity of these valuations persisting, right?
Yeah, absolutely. And the well, we'll get into it more later. I'll save that because it'll come into play more.
Oh,
Um,
perfect.
yeah. So
So let's,
momentum, I think
yeah.
we all know about momentum. It's had a really really strong year. Some of the things that have been kind of in that basket, I mean, they've just gone just kind of straight up. But the problem is when things do this, they just become wildly overowned. So there are some names
Yeah.
in the momentum basket that they've gone straight up all year. Everyone owns them, even non-momentum people that just saw it go up. Maybe they're not betting on the factor, but they're still betting on some of the names in the factor. One of the reasons that concerns
Yeah.
me is that can be kind of self-reinforcing back to the downside. As they have to sell, they get hit, and then they have to sell more. Like, it just, one of the many feedback loops we have in markets today that are very important to me, at least.
Well, the interesting part is that those people that don't own these stocks suddenly realize they need some exposure there. So they sell some of the stuff that's not working and chase after it. But there's a second factor, which is these things are going up at such a pace that just by having owned it already, your the percentage of your portfolio that you have on it keeps increasing. So you're becoming more and more concentrated in that basket, because that's the only part of your portfolio that's growing. The thing that almost always drives a market correction is simply a portfolio rebalancing. The point is that you don't even need these people saying, oh, I'm just going to abandon it, I'm going to get out. when a manager originally had a 10% allocation and has grown to now being 30% of their portfolio, at some point they're going to say, no, I got to bring this back to just being a 10% weighting. Just the amount of selling that happens when they have to rebalance is in itself going to feed the corrective phase in the market, right? Like, and this is what drives so many of these market cycles. But let's move on and talk about this Shiller PE ratio.
Yeah. We can spend just a second on it, but I think a lot of people know the Shiller PE. And I want to make a point, and it's to highlight the work of Warren Pies. That they did a piece at 314, just showing like, yes, like PEs are really high, but here are some reasons why it makes sense that they're high, like profit margins being at all-time highs, like that excuses some of it. The fact that tech is a way bigger portion than cyclicals, versus 10, 20, 30 years ago, and tech always carries a higher multiple. So there are real reasons that PE ratios should absolutely be higher than we're used to. But at the same time, I think, some of it still is kind of egregious and points to nothing other than passive flows to me. Like, Apple trading at almost 10 times sales, as just under 10 times sales, as a $4 trillion company with, low single digit earnings growth for the last 3 years. Like that's kind of crazy. And that suggests like none of those like reasons to me can explain something like that from that company. Or like Walmart's trading over 40 times PE. Costco is like, I don't know, 50, 60 these days. Like some of those are like, I'm cool with the index having a PE well above what we're all used to from the last 30 years, whatever, but not some of this stuff is a little crazy. So yeah, the Shiller PE, you're about to go hit that 2021 blow off high before long. But if Mike Green's right about passive, and we keep getting the net positive passive flows, not to mention all the share buybacks that reduce share count, then yeah, you can go to the Shiller CAPE ratio of like what Japan had of like 80 or whatever.
Unbelievable.
Yeah.
Unbelievable. You're talking about valuations as well.
Yeah, it's just a chart of S&P trailing and forward PE. Same thing. Like you've kind of gone to the highs close to of 2021, and you're not really too far from the .com peak as well for both trailing and forward. Trailing is more aggressive for now, which obviously makes sense. But at the same time, forward PE, I think the market's expecting like 12, 13% earnings growth next year. So if that doesn't come in, then that forward PE has a problem too. And the numbers, you're trading at about 22 times forward PE, which traditionally pretty expensive.
Now, what's your take? Like, if you look at the last 2 decades, there you can count on both hands how many times we've had periods where, and sometimes not even within recessions, where corporate earning contraction happens, and where we often can see like earnings contractions of anywhere from 20 to even 30-40% pullbacks out, and that's not even talking about the 80+% contraction that we saw in the financial crisis, but let's call that an outlier. But it's been common to see earnings contractions. Like, so when you have these kind of multiples, that's an assumption that the E part of the PE is going in only one trajectory, right? Like you have a scenario where, if you're trading at massively high multiples, like how would you interpret this? Like when you have such high multiples, it could be a double whammy where if earnings and all stop, even pull back 10%, you can't almost justify multiple on something that is contracting, no?
Yeah, exactly. The market would have to stay flat, and that would still be just a giant blowout higher in the PE, which tells you a lot, and that's one of the reasons like I'm concerned going into 2025 is, if you think about going into the last 2 years, Wall Street was worried about a recession and saying stocks are going to go up low single digits. Now,
right,
going into, and we went up like 60% in 2 years instead. Now they're not worried at all about a recession and saying, we're going to go up like 10%. It's like, Okay.
I'd love to get your take on it. Let's go dig deeper into what you just said there, because uh, we step back and look at the fact that typically one of the most consistent drivers of recession are when central banks tighten monetary conditions and maybe tighten too much or even spur on, but ultimately it leads to some form of an economic contraction that we can label a recession. And they most commonly happen after a rate hike cycle. And we've obviously are there in the monetary cycle. And yet, at least up until now, the recession has not emerged. But really, the sentiment has become that because one has not yet happened, therefore it won't happen. And they've literally are like, when was the last time you heard anyone talking about use the language soft landing versus no landing and hard landing? Like, we stopped talking about it altogether. I've heard nobody. Like, do you think the market simply, is there a potential that suddenly people are just going to say, well, maybe recession risk is a little bit higher than zero, and that we have to start talking about the idea that next year there could be still economic challenges in spite of a Republican government?
Yeah, and the thing is, to me, is you might have it because of the Republican government, and that in a way you might have so much good stuff that it's bad, because one of the worst things that could happen is you heat up enough to bring back inflation, to where the Fed has to get back in the game. Um, but I, I still see some things that are kind of legacy problems from the last few years that are just really slow developing. The first and foremost is housing. Like, you you had such a boom in housing that having it go the other way was, I mean, sort of inevitable no matter what. But
Yeah.
at this point, building permits, housing starts have broken down to a level that suggests you're going to have a contraction in construction jobs. And construction jobs, in my opinion, again, well, a lot like my buddy Warren Pye, is like, is kind of the keystone to the business cycle. Now, I
Yeah.
can imagine, them pulling back and even having negative non-farm payrolls and not having a recession, just a big, a pretty good slowdown. But that recession risk, if you start losing construction jobs, becomes very real, and no one's thinking about it, despite the fact that
Yeah.
you just throw up a chart of units under construction and housing and construction jobs, and you're like, ooh, that looks like it's going to get bad at some point in
Yeah,
2025.
you were writing about that in this recent piece, but definitely, like, you having turndowns in building permits and homes under construction, everything is contracting. I mean, inevitably, higher interest rates are going to make the access to homes more challenging. That's the whole point of tightening,
Right.
right? And we're finally seeing that is now trickling in to these numbers. The question, and like you were saying, is it just going to be a modest little slowdown and not drive a recession, or can it be something bigger? But the question then really becomes, has the market even begun to price that in? Like, is it right now only pricing in essentially the best case scenario?
In my opinion, absolutely the best case scenario, especially when you think about stuff like that. And one thing I'll add, it kind of further answers the prior question. Like, I think a lot of people are taking comfort because the Fed is cutting rates, um, and obviously that makes sense historically. But at the same time, I wrote a piece a few months ago that I titled "Not Your Grandfather's Rate Cuts," and the whole point is that, yes, like, they're going to cut, but this last cycle we were at zero. Even people talking about going negative with a bunch of QE, with a bunch of fiscal. Um, so the chances that we go back to zero are obviously pretty slim, I think.
Yeah.
Which means, for the first time in a lot of our lifetimes, and definitely most of our careers, the interest rate, the policy rate will make a higher low. You're not going to go all the way back down, and that has like huge ramifications that people aren't thinking about. Like, everyone, basically termed out their debt at record lows, which means all refis from that point forward reset higher, even if the Fed cuts rates. Not to mention, most debt isn't tied to the policy rate. It's tied closer to the 5-year or 10-year. And those aren't low. Those have gone up since they started cutting rates. So yeah, that's an important point. Like the 10 years up since they started cutting. So who cares if they cut rates? Like other than people that borrow floating rate money. Um, but if you have a mortgage, the effective mortgage rate just keeps climbing. Because most people have a 2, 3, 4% mortgage, and now it's 6. So that doesn't do much for the economy when you cut. It actually does virtually nothing when you cut. So I still think everyone has to refi into higher rates than they had, and that continues to be a drag. And that's the kind of thing no one is talking about or paying attention to right now.
Oh, absolutely. And in places like Canada, it's even that much worse because they don't have 30-year fixed rates, and everyone's mortgages comes for renewal in this last couple of years, making many Canadians have their mortgages double on them. It's already creating a big drag up there, and inevitably, I think the U.S. Mortgage market makes it a little bit easier to have less risk there, but it still drives flows. It still drives a mortgage availability, how much credit you're approved for and so on. But the one thing I wanted to also just mention, very few people ever seem to mention, but I think it's a big thing. Most commonly and very often, almost all recessions happen during rate cut cycles. It's not the rate hike cycles where the recession occurs. And there's a lot of people that make the conclusion that just because we survived the rate hike cycle without a recession is evidence that a recession can't happen. But yet, if you look back, the recessions are almost always during the rate cut cycles. It's so, it's just, I think it's just too early to jump to the conclusion that one can be avoided just yet.
Yeah, I would say the good pushback to that would be, the Fed usually breaks it and then has to cut. So, and this time you can argue they cut before they broke stuff. They were kind of more proactive. But going back to that, like, people still are gonna have to reset rates higher. Obviously not as bad if you're near the short end, but still it's, and you're already seeing people kind of give up on lower rates. The perfect example is auto sales. Like, the 5-year yield is pretty high. That's more or less the proxy for a car loan. And you just saw auto sales absolutely rip in America. And it was like people just finally were like, I thought these rates would come down, but I cannot drive this hoopty, another mile. So I just gotta go eat this 8%, car loan.
Right. And it's obviously high interest rates will ultimately have to be passed on to the consumer, and it's just a lag time of how long the market realizes that. So let's go through a few more of these charts. You're talking here more about the sentiment shifting to the bullish side, particularly in all of these different assets. What are you seeing here?
Yeah, it's a cool chart that Goldman does. It has like 17 different things on it, and it shows like between risk off, risk on. And they've re-released this since with the new data, and it's gotten even worse. So essentially, everything has gone more and more risk on, and some of it is just completely just pegged out, all the way kind of 100th percentile. Like probably a third of the measures at this point are just mostly flow data. Just pegged out 100%. Like things like the put call, ratio got worse. Some of the momentum stuff I think got worse. I mean, the VIX is basically free. The AAI bull bear, that I'm pretty sure has gotten worse since they posted this one. There were two things that I saw that pushed back against all my scary charts, and that was the fear and greed index wasn't that bad, and then the AAII bull versus bear wasn't that bad. But then it has since started to go the other direction.
Yeah, absolutely. And so here you're talking about household allocation to equity, bonds, and cash. How are you interpreting this?
Yeah, so households have never been this exposed to the stock market.
Right.
And a lot of this is, I think most people have met someone in their 60s, 70s, and they're still basically all equity. That's actually pretty common at this point, which is, it's very scary because if you've made it to the point where having a drawdown becomes a its own fundamental in the real economy, where if stocks are doing great, people feel rich and they spend a ton of money and the economy does wonderful. And I've mapped this data out from financial conditions to all of like the macro data, and financial conditions lead macro data. It's very, very real correlation. So if stocks pull back, especially if housing pulls back, it just smashes the real economy with like a relatively short lag. And the fact that more people are more exposed, now than ever, it just makes that more intense. And if you do, you know, stock market exposure compared to GDP, like that is a hockey stick chart. So
Yeah.
That
Uh,
flow back into the real economy from financial asset prices is extreme.
Well, in this, you can see that cyclicality at its most extreme by looking at crypto kids' spending habits when being directly correlated to where crypto is, right? You have a Bitcoin double and suddenly the Lamborghinis and parties are happening everywhere. And, you have a pullback and suddenly the spending is scarce. And so like you're just simply saying that is evident with all risk assets. Little more with the crypto kids, but otherwise,
No
anyway.
doubt.
Let's move on here. So here you have the mega spicy zero caution. What is it? How did we move from spicy to mega spicy?
That I didn't know how else to talk about this chart going straight up. So is a Cinnamon Trader posted a chart of the Ridex total leveraged bull assets. And the chart goes back to basically 2000, 2001, something like that. And it's been spicy. So you go back to 2021, you had a crazy new all-time high. Well, we just took that one out and just left it in the dust. Like, and it looks like the chart's about to bend backwards to the left. It went so straight up. And they even have like a longer run one that I inset there that it's just off the charts, straight
Right.
up stuff. So, and Cinnamon Trader's been a good follow lately because they're showing all kinds of just wild blowouts and long history sentiment and positioning, indicators.
You know, the these bull markets almost have to run long enough and far enough to make every bear lose all appetite to short, because it seems like a hopeless task to do. And at the same time, just convince all the bulls that the only choice they have is to stay in, right? Like it has to reach that sentiment point where it just everyone has to be in agreement. And when everyone's invested and fully leveraged and in that positioning, that's that extreme moment that creates the pivot that ultimately drives market corrections, right? Uh, and now we went from crazy spicy to no words at all. What's looking at here?
Yeah. So this is Cinnamon Trader again, and this chart goes actually back to the 80s, and it's small spec index position. And I don't even know how you describe how far above normal the chart goes. I want to say they have a little dash red line that is like a one standard deviation above normal or whatever, and it looks like a SpaceX rocket has blasted off from that and is already on Mars or something. I don't think I've ever seen a chart quite like it. It's just wild.
And the interesting part that has potentially allowed this market to be extended to this degree is just how easy it is now for the average person to access leverage, right? So before, managing a margined position was something that wasn't commonly accessible to the average person, but now you can go into an IRA account or some other account and be buying 3x leveraged ETFs. You can go and buy all sorts of futures exposures where they're allowing you to carry these things like with 5 and 10 times leverage, and most people think that that they can manage it because it's only going to go higher, and allows these traders to just lean really into the long side, and therefore you have these guys that look like complete rock stars because all they've been doing is like leaning in and compounding into this high leverage. It's insane.
Yeah, exactly. And you know, leverage is what creates nasty moves to the downside at the end of the day. Like, I mean, I've been bullish since the fourth quarter of last year, and it
Yeah.
was really just enough. There's a couple little periods where I was a little more cautious, like last summer, but um, you just didn't really have a reason to be too worried. Like there was still a wall of worry to climb. There was still people that weren't, kind of shoved all in. Like there was plenty of stuff that you still felt like, well, I think we'll be fine here. And then just from the election on, like it seemed like every dollar that could find its way into the market did. Um,
Yeah.
and I can't remember if I have it in this slide deck or not, but like you can even see it with cash levels for mutual funds, for hedge funds. Like the cash level on that stuff just vaporized to nothing.
Yeah.
And going back to that conference board chart, this one here is Renaissance Macro, basically just taking that and doing it on a kind of long run average, and you're basically 2 standard deviations above the history of the thing.
It's insane. Well, I'm pretty sure we get the gist of
Yeah.
where you're going at with all of these things. Now the bigger question is, okay, so we're showing all this extreme, and I think the what I'd love to just pick your brain on is like, what do you think would have to happen uh, in order for us to kind of like, do you think things have to go even that much more extreme to blow off? Like, what is it that ultimately is going to create the kind of mean reversion in almost all of these charts? At some point, we will. Like, if you look far enough into the future, we know there's going to be a mean reversion here. The question becomes, all the listeners that we have are engaged in the market and they would love to, let's say, profit from a market turn. But the question becomes like, what are the kind of key things to watch? Is it just like what we're about to do when we do some talking charts? Is it just throwing down some trend lines and seeing when the kind of market pivots? What is it that you'd be looking for to kind of give you the clues that something has shifted?
Yeah. First of all, like at the end of the day, the easiest way to do it is to kind of wait till it starts to break. Like, shoot it in the back. Like I don't believe in shooting or in betting against markets that are like if it's making an all-time high, like I don't really understand the point of shorting it, but at the same time, you look at something like Nvidia that has broken down below its 50-day. Kava has been one of the darlings. Palantir, like
Yeah.
there are some names that sort of capture the animal spirit moment of the last month and few months,
Yeah.
and some of that stuff has weakened. But as far as trying to like time things for me, when dealers go over into negative gamma, like it that opens up that kind of window of vulnerability for vol to go up for some selling. We know systematic positioning is very high again. CTAs are very, very full stocks. So, and honestly, like it doesn't even matter to me what the catalyst is. Like pretty much nothing bad can happen right now because everyone bought, everyone's in, and that includes
Yeah.
global flows. So it's not just Americans. Like Mrs. Watanabe's buying, like everyone's buying. So if anything bad happens and a couple people sell, like that becomes a problem. And then if that leads to systematic having to sell because vol's moving up, like it just becomes everyone has to sell because their rules or their psychology tell them they have to. So really it the biggest thing to me is like if you start to get a pullback, like don't doubt that it can become a bigger one. That's one of the keys.
Right. And so let's just touch on one or two more of these charts quickly. And I'd love to just ask you about some of the different stuff going on in the commodity markets. But here you have this for this presentation, 11-year highs are in for. Why don't you explain what's
Yeah.
what's going on here?
So it's from the Bank of America Fund Manager Survey, and they showed like pretty. I mean, fund managers were were bullish, but it wasn't a huge deal. And this is the net percent of overweight U.S. equities. And right after the election, this thing just gapped up to an 11-year high. And I was just making the joke that for this presentation, 11-year highs are for ants, but it's still, hey, an 11-year high is an 11-year high, especially when 2021 is in the data set, because that was
Yeah.
pretty wild.
Yeah, yeah. And all right, so I think is there any one last chart that you wanted to quickly reference in here that you thought was worth talking about, or is that this is the gist of it pretty much accomplished?
Yeah, I think so. And this had like 40 something in it. We probably did 20, and I just released another like 25. Like I don't know. There's nothing else you need to hear if
All
if
right.
you haven't grabbed onto the fact that the market's throwing out a lot of warning signs.
All right. Well, then we have to end with talking about Jim Cramer here. And obviously the market loves to, or at least the Twitter sphere loves to fade the infamous Jim Cramer. So what are you showing here?
Yeah, so this is an Aaron Chopra tweet showing where he got bearish and where he got bullish. And it's much like Nvidia. Like when it's hitting the dead lows, he hated it, or oil, he hated it at the dead low.
Yeah.
And then it blasted off to the new highs after the election, and he turned bullish. So I think everyone listening probably knows what to do with that.
There you go. Well, listen, Chase, I normally we would end the interview and thank you for coming on. But listen, Kevin needed the week off, and I wanted to talk some charts, and I can't think of a guy that I would rather talk some charts than you. Are you willing to stick around here and do the talking charts with me?
Yeah, let's do it.
Fantastic. All right. So let's do it. All right, Chase. Let's talk some charts, pull out the crayons, and have a look at what's going on now. A couple of weeks ago, I was talking with Kev about the top 3 things to watch in the coming weeks. And we were looking at those inflation numbers, job numbers, and whether Bitcoin was going to crack 100,000. And well, Bitcoin did crack 100,000, and certainly a chart we can look at here in a moment. But, all of the anticipation that some of these economic news were going to be market movers. It's been a big ass nothing burger in terms of reactions from the market on these economic news. Is there anything you wanted to kind of comment on that?
Yeah, I'll just say it's kind of interesting because CPI and PPI both came in kind of warm and worrying. But if you back out the stuff that flows into PCE, which the Fed cares a little more about, it actually came in pretty muted. So it was like an interesting, dichotomy there. So at the end of the day, it was enough to make the December rate hike just fully baked in.
All right. So let's talk about the top 3 things I want to watch in the coming 2 weeks. And the first one is whether it was a fake out or breakout on gold. And when we look at what happened here on gold, just obviously it's been a tough 2 days, but we basically had like a triangle formation developing on gold. It got back above its 50-day moving average, had 2 strong breakout candles, and it's still above its 50-day moving average. It's still there. And the big question here is this going to be the beginning of another leg higher up to 3,000, or is this just a retest of the highs, very similar, like almost like a double top retest like we saw back in April and May, where after popping back up toward their highs, still spent several months just grinding it out in a consolidation. And that's I think one of the key things to watch. These types of pullbacks, in my opinion, are where you get all the information. Because if the buy on dip traders show up and get that momentum build up again and get it back above 2,700, then that could be the beginning of an accumulation cycle. What's your take on gold here?
Yeah, this one's very tough. I thought that higher high was a very real breakout, and it was gonna, we're gonna go back to the highs. But this 2-day reversal has been pretty nasty. And that 2-day reversal, it coincides with dollar and yields going straight up. I mean, the 30 years up like 12, 13 basis points in 2 days. So that makes me nervous that I was wrong to think that higher high was something.
I'm not ready to put the nails in the coffin on the breakout just yet, but we're right on the line. Like this 50-day moving average, the ascending trend line, all of these things are right there. If gold can't hold that 50-day, then it consolidating for the rest of the year or even the first few weeks of January become a real possibility. I still, in big picture, very bullish gold. It was just the puzzle of whether or not the next leg was starting now. And that was what
Right.
we're trying to kind of solve the puzzle on there.
One of the things that concerns me is looking at the COT data. I was hoping more of the longs would kind of get out of the way. I was hoping like a third of that like net position would kind of burn off. I mean, we had a pretty big pullback, and
Yeah.
you look at that, and it's like, oof, like, yeah, like it's better than it was, but not too much better. But on the flip side, China took a 6-month break from buying gold, and now they're back. So that's the thing that makes me, want to believe that this is the next move higher.
They're not going to complain if they're starting to buy if gold just stays flat for a couple of months. I'm sure that they don't want the price to run away on them, and
Sure.
so they're not going to be complaining. So number two, does the S&P 500 gamma pin prevail? So we have the big J.P. Morgan whale who does the collar strategy, have like 40 some odd thousand contracts of S&P covered calls that were basically sold at the $6,055 strike. And while if the market doesn't go near the strike, then it can move without volatility. But as you get gamma pinning, as it kind of falls, I like to describe it like when a meteor falls into the orbit of a planet. Like when you get close to that strike, suddenly the gamma starts to rise for the dealers to get closer to expiration. Then the dealers are playing that much bigger of a role in flows. And so now we have this scenario on the S&P 500 where basically dealers are selling strength and buying weakness, which is actually reducing volatility and pinning the actual S&P. And so my kind of question here, with us being halfway through December, is the gamma pin prevail? Are we going to more or less have a ridiculously boring S&P price action for the rest of the year? Any opinion on it?
I lean towards yes, like it will prevail, and it will be boring. And I'll extend this further to say I'm like a lot of people. I'm worried about that January OPEX as being a moment of pretty big vulnerability, but it creeps me out that I feel like a lot of people think that.
Yeah.
But yeah, it's going to be interesting, like to see. Normally the back half of December and beginning of January is wildly strong, from a seasonality standpoint. But we've been so good lately. It's like, well, maybe we already did enough, which makes me feel like maybe we can just stay pinned here. Yeah.
Yeah. And so that kind of segues into number one, which is we have the FOMC meeting next week. And it's really the last major economic data point and news event or conference of the year. And to point number two, I think that if the FOMC can't be the catalyst that kind of pushes the market out of the gamma pinning orbit, then that truly will very likely mark, like we obviously have option expiration as well on the 20th. And so you basically have a scenario that if this doesn't move the market, then the market likely is going to do nothing during the holiday weeks. And so what's your take on, do you think that we're going to get a surprise from Powell, or is he just going to ride it out until the new administration's in office?
Yeah, I lean towards the latter. I think it should be well, I don't think they should cut it all, but I think if they're going to cut, it should be a hawkish cut. And I could see him mildly leaning in that direction, just kind of warning like, hey, we did 100 basis points. We're gonna chill out for a little bit. Like, not saying we won't cut, but we're gonna cut every meeting anymore. But even then, the market is already pricing that in. So, and in fact, you go back 3 months, the trough rate was 2.71. Yeah. Now it's 3.56. So the market's already essentially taken out 3 terminal cuts. So granted, that was an insane pricing for a little bit there, but yeah, I don't see him rocking the boat. I think he wants to get to next year and see much more data, and see what the new administration is going to do before he says too much.
Yeah. All right. So let's pull out the crayons. Let's talk. So here's the gamma pin line on the S&P 500. That's just like where the strike price is open, and you can see the last 5, 6, 7 days, the price is just orbited around the zone. But what's interesting is while the S&P itself has stayed flat, it has given the perception, and even with the VIX, trading in the 12, 13, 14 handles on the downside, it's given the perception that we're in this low volatility regime. But under the surface, it's actually been chaos. Like we're seeing things like I'm just going to start off by looking at the chart of the correlation index, which is down to 11%. I mean, we basically are seeing so many underpinning assets just moving sporadically and uncorrelated in there. And the one most blatant thing is obviously the mags, which you have a scenario where there's just this parabolic rise going on in the Mag 7 stocks. This is the Mag 7 ETF. They were saying they make ETFs for everything now. This is no different. And so you have the mags ripping, but the equal weight S&P 500 has been doing what? It's been tanking.
10 straight days today will be 10th straight red candle.
Exactly. And so, and more importantly, the Russell, which was a huge popular trade that, the Trump Republican victory was going to bring middle America back. And again, 10 straight days of selling. And so this is clearly depicting the sector rotation that's underneath, which is basically all this idea of, this broad rally, financials, all of this stuff was all going to work to everyone's just got to own the mags. And if you don't own the mags, you're not participating. Like they're literally, the market breadth continues to deteriorate. And everyone says, well, it's got to be the NASDAQ. But when you look at the percentage of stocks on the NASDAQ that are above their 50-day moving average, we're at 50%. In other words, the Mag 7 are not reflective of what actually the other NASDAQ stocks are actually doing. Even the breadth of the S&P 500 was 90% at the start of the year. We were down to like 80% during the summer. And then we hit a peak of 70% just a month ago. And we're back to 50% of stocks above their 50-day moving average on the S&P 500. We continue to see the deterioration of the market breadth as the entire market participation keeps getting into the narrower and more narrow few mega cap stocks that have been working. What's your take on this?
Yeah, it's not been happy holidays for the broadening bros, that's for sure. And you're right, like the under the surface stuff, advanced decline, like new lows versus new highs. I mean, you name it, has been pretty rough under the surface. Even like you mentioned NASDAQ, you go like equal weight NASDAQ, just it's terrible. Like,
yeah.
So it's really, no kidding, been just those 7 stocks. Call it 8 if you add Broadcom, kind of turning into the Mag 8 now that they're $1 trillion company. But yeah, I think going back to like earlier in the show, like that, you're getting some fundamental reason for it to go up, and then I think just the average person sitting on their hands while the average 401k is not sitting on its hands is a big part of it.
Yeah.
I'm not saying it explains it all, but I think it's a big deal. But then, hey, Interactive Brokers telling us that all the individuals are just jumping in there buying them too. But what's notable to me is I think it's an actual function of what's going on, that equal weight has to go down while this happens. Like Mike Green's talked about this some. There's been some like academic studies showing, like literally it starts to suck the oxygen out of the room. Like it if you're like towards the bottom on market cap, it's almost mathematical that you have to go down and give some of that like energy to the Mag 7. So and it maps on pretty good. Like as soon as Mag 7 blasted off equal weight, this couldn't even have an update. IWM could not have an update.
Yeah.
So I think that is that's actually like a real relationship, which is a scary relationship, but I think it's real.
So the bigger question in my mind then is the blow off of the Mag 7, when they eventually reach that point where the fuel that was driving them just runs out and there's simply no incremental further gain that can be made before a profit taking cycle starts. Is it going to be enough for the rotation to be going back and widening back into other sectors to hold the market up? Or are they going to just get so big that no matter what happens, even in sector rotation, that the indices have no choice but to go down just because the Mag 7s have just become such a huge weighting in it that there's just nowhere else to compensate?
Yeah, I'm of the opinion you can have pretty good pullbacks in Mag 7. You could have nice. I mean, we had like 6 months of, well, 5.5 months of outperformance of equal weight versus Mag 7. I think you can have those periods, but I think as long as passive flows are net positive,
Yeah.
so all that money's going cap weighted, right? Like, as long as those two forces are there, at the end of the day, over time, they will. This like they have their own like gravitational
Yeah.
pull, and that orbit will continue to do what it does. Uh,
There you go.
so you have tradable like counter trend moves against it, but I think the secular trend until passive flows go net negative is for Mag 7 to outperform.
The interesting part it reminds me of is back in 1999, as the markets were peaking out in 99, 2000, in the final stages, the NASDAQ was ripping higher and the S&P was flat. You basically had a scenario where all the money was just simply chasing those .coms. And so the curious part is now that the S&P is sort of and the equal weights and even the S&P gamma pinning, like we're seeing basically the markets itself stall out, but the Mag 7s are the ones running. And I wonder whether that kind of comparison plays out similarly.
Yeah, absolutely.
All right. So I wanted to talk to you about oil. The sentiment on oil could not be more bearish. It's not even bearish, just no one gives a shit anymore. Like people don't want to talk about oil. No one wants to think like it's been left for dead. But it has been in a trade range fair value zone down here where basically there's become an equilibrium of buyers and sellers. It stopped going down basically. Do you think that this is enough for oil to put in a bottom?
Maybe. I hate to say I'm like one of these people that stopped caring, but I feel like that's kind of the case. Like, so just on the pure fundamentals, like obviously the OPEC news, their decision helps, like, literally with the fundamentals in the next 6 months, call it. But like, we just have too much oil. Like at the end of the day,
Yeah.
so it's hard for me to get bullish, other than tradable rallies back up to the higher ends of the kind of trading range, but you're right though, like that. So like if you go like Z25, like the 65 level, it just keeps defending it over and over. But then you get up to 70 and you can't get higher. So you're like, you go out to Z25, you're in a $5 range. And I think you could break down below that 65 on that one. We just have too much oil, like, and too many of the bull cases depend on
Yeah.
OPEC continuing to keep oil off the market, which to me is a bad bull case. Like that's not. I don't want favors from OPEC for my bull case. And then a lot of people are like, oh yeah, well China's going to boom again and they're going to buy tons of oil. Like everyone's wrong that their demand is going to stay bad. But when I look at the trends on things like EVs and LNG trucks, like I'm not so sure. And not to mention their population's falling. So
Yeah. Well, I mean, we can make demographic kind of thing calls, but I think in the bigger context, it's about whether there's a trading opportunity here. What I just know is that no one seems to give a shit right now, which is interesting because when no one's paying attention, sometimes the market surprises. And I wonder whether or not there's a short squeeze opportunity because I think there's a lot of people out there that are very cocky about carrying their oil shorts. So, even if it's just a liquidity driven event, not even a real fundamental reason. There's a shocker like October where we ripped from 66 to 78. It doesn't mean there's a new bull market, but there certainly can be a bit of a squeeze because nobody's watching, nobody cares, and there's way too many shorts. And that's the type of market that typically would get squeezed.
Yeah, and as you have it on the chart there, like you're starting to kind of finally maybe take off from the moving average a little bit. So, and if you put in that higher high up at whatever that 73-ish, then
Yeah.
why not like a quick run to 78 or something?
Yeah, there could be a tradable thing. Let's talk currency, buddy. This dollar index. Okay, so I'm going to put on a weekly chart because we had all of these highs on the dollar index back in the 106 to 107 range. We broke that with a punch to 108, and it looks like the dollar wants to go. And typically, when you have dollar strength, it often is in the backdrop of some sort of risk off. And the bigger question here is the dollar setting for up for a breakout? And I'd love to talk about the individual components. So if you want to specifically talk a particular currency pair, we can. But let's just take your bigger view. Are you still dollar bullisher?
Yes, I don't want to be, but yes. To me, so like I'm not asking you to draw this because it would take forever, but like I drew a line on a quarterly that goes back like 30, 40 years. It's 106.93, and that level like has been a big deal for a long time. So that was when we punched to 108. It finally kind of got whacked by that 106.93 level. So if we can sustain above that level, then it's kind of it's worrisome, frankly, for everything. But that's an interesting thing about the equity market is largely doesn't care. But I think if we blast above 108, like, and it's a quick move higher, then I think basically every asset price starts to care. But yeah,
and that's why
I don't want to be bullish, but I am. Yeah, exactly.
Yeah. The interesting thing is that euro weakness is so evident. Like typically, you'd expect a solid 50% retracement, testing moving averages after such an aggressive sell cycle, and the thing can't get off the mat. It's like the euro's dead. And and when you really look where it traded during the 2022 decline down to like 95 cents, you can really see that the vulnerability comes on a potential euro weakness. And when you really look at the macro conditions in Europe, you can see reasons why this could still happen.
Yeah, it's a lot needs to go right in Europe that isn't going right in Europe to get it up. And the little bounce we did have at the end of last month was because Lagarde came out and kind of made it sound like, we might not do a bunch more cutting, and then since then a bunch of bad economic data has come out and everyone's like, well, they're probably gonna have to do much cutting.
Yeah, and the cleanest bear chart is actually the pound sterling. I mean, it came right to that 50-day moving average on this little bouncing flag. These breakdown candles are as clean as is going to get. And it looks like that pound sterling can easily head back to 123 on the downside. And so this is where all the kind of currency compounding, you like take the Aussie dollar trading pretty much right along its major lows. You look at the US CAD breaking out to levels we haven't seen for you have to go all the way back to the spike during COVID to see levels where the CAD is traded to this. Like the Canadian economy continues to suffer, and the outlet is the currency, and so this is all compound. The only thing that's left is talking about the yen, which obviously my co-host here, Kevin, is long-term bullish, and I get it. The yen is stupid cheap, but it does look like that this thing wants to join the U.S. dollar bull party.
Yeah, I think I got stopped out of it yesterday, so so there you go. It was the only dollar short I had left, and it got rid of me. So I still like it just because it's like the one place in the world they're actually, well, in Brazil, I guess, but kind of raising rates. So it makes you feel good, like, hey, Fed's cutting, they're raising, like, this at some point can work. But you're right, like so far it looks like that was a corrective move.
Yeah, my kind of pushback on being bullish the yen, because first of all, I understand the bull thesis, and I think Kevin will be right over the long term, and all those that are there. But if this is a U.S. dollar driven move, then it's going to drive flows irrespective of current individual currency fundamentals. It just may be on a relative basis.
Yep.
The yen will do better than, let's say, you can do something like the euro yen cross, and you can bet that the euro will structurally remain weaker than the yen, and you can be playing that relative play. But I think that if with the US dollar rallies, it's going to be a US dollar driven catalyst. And it's going to be very hard for any cross currency to fight that kind of a headwind.
Yeah, 100%. It's a great take. Like if you want to be long the yen, that's fine, but like go put it up against something else. Not the dollar's probably the way to go in this regime.
And especially when we're thinking about it, that it's really potentially changing, U.S. economic policy, things like tariffs, all these other variables that are coming in that are going to be bigger overarching themes than just looking at the fundamentals of how things are playing out in Japan, right? Anyway, we got to talk a little bit of this nat gas. I'm going to just, instead of going to the individual futures, I'm going to just use this UNL, which is the 12-month strip. So it's just looking at a strip on the nat gas. So rather than us picking little spots on where in the term structure we want to be on nat gas, overall it's been ugly, right? Like it's been an awful bear market in natural gas, but it really stopped going down for the last 6 months. We've been creating an extended basing formation. Do you have a different view on nat gas from that of oil, or is this one of those things of leave it alone?
Very much different view from oil. I love nat gas. I am worried, I'm worried about the rest of the winter because it's been poor so far, and if January, February, March come in pretty warm, that's a problem. But at the same time, this past week we had a great storage withdrawal, like way higher than expected. Made a lot of picked up a lot of gains against the 5-year average and even versus last year. So very bullish stuff. You have LNG exports hitting kind of 14 BCF a day and probably going to get a little bit higher as Plaquemines opens. So there's some very, very bullish catalysts. It's just you may have to limp through the winter. So like what you're showing, the strip, like, or the equities are being out a year or two, like those are the ways to play it. Like if you're trying to play the January, February, March time frame, like that's a good way to get in trouble. But
do you have a favorite nat gas play? Are you like doing the like Range Resources, or is there a particular one that's kind of your favorite to put it on with?
So there's a good one in America and a good one I like up in your neck of the woods. EQT for the US, and then in Pato for Canada. EQT like looks obviously way better than the chart of gas itself, and that's kind of a notable thing. Is a lot of the equities have really performed well given the price kind of backdrop.
Right.
It's been notable, and some of them are giving you some shareholder yield with either buybacks or dividends or both. Like, so it's not even just the price appreciation. And then it was another Trump trade. Like it rocked higher just because it figured Trump would be helpful, which it probably will be on the LNG export side.
Yeah, absolutely. Now I want to move on to bonds, but before I do, is there one particular commodity that you wanted to touch on that I didn't reference that you think is worth?
If you can pull up sugar, if you have it available, it's one. Yeah, like that chart I find just endlessly fascinating. So it's like it's like you had like a technical analysis student draw a bull flag or something.
Or like the handle of a cup and handle forming or something like that, like it's ready to go. And it's interesting because there's so many commodities that are running, like another big cocoa breakout on the upside. You have coffee, which has been running. So it's like, why can't sugar join the party, right? Like it's
Exactly.
there's been a few of these. It's interesting because there are so many commodity bear markets going on, but the few of these, when you're getting into the softs, are running. And the interesting part is it's not easy for an average equity investor to access these markets. You pretty much have to be a futures trader to kind of come into this realm, right?
Yeah, to do it well. Like a lot of people are crowding into like DBA, and DBA just turned into like a cocoa fund, whether they want to admit it or not. And I see people posting like the DBA chart and like, oh, food inflation's coming back. I'm like, yeah, you should go look at the way that's constructed. But
There you go.
yeah, like I'm always watching the ags. I always want to be along the ags because it's such a differentiator to other markets. And I was long coffee probably 5 different times this year, and then I missed this giant rip, which is super annoying.
Super annoying. There you go. The so let's talk interest rates and bonds. Now, actually, I'm just going to use bond futures rather than rates. But so obviously, when we're looking at shorter dated, it's like this is sorry. Let me go to the 5-year note, so here we can see that there was a substantial drop as yields were rising. A little bit of a pause, but the last few days, I was really thinking that if the bonds were going to make a big move, it was going to wait till at least the FOMC, and it really all seems to have come alive here in the last few days. You think it was just the recent data points that have spurred this, or is there something more to it?
So, in my opinion, a lot of it is the fact that that Fed cut got crystallized. I know it sounds weird that yields would go up on the Fed cutting, but that's my view, especially on the back end. Like the back end realizes they're kind of playing with an inflation
Yeah,
reacceleration and cutting, and it doesn't like that. Um,
yeah.
so
Oh, that long
yeah,
bond really ate it. Like look
oh
at the
yeah,
way like 4 handles on the downside in just in a week, and just unbelievable drop.
yeah, and right after it settled above the moving average and got everyone, including me, out.
There you go. It was a crowded trade. I mean, when you've got some legends on the street, all
Yeah,
touting that bearishness, it became an incredibly comfortable place to be, and that market just gave it the squeeze.
yeah, and like I figured, equities had the year they had. There has to be a few bucks that needs to rebalance into bonds, and I was
Yeah.
just like, it'll probably do good until the end of the year. Well, sure enough, nope.
All right. Listen, I'm going to let you go soon, but I wanted to just talk some global equity. First on, just 3 charts I want to talk about. First of all, the Nikkei. And obviously, there was the carry trade wipeout that basically created an incredibly unique opportunity. Obviously, mean reverted, but after that quick mean reversion, it's been a dead market. And it maybe this is what is actually making the US equity and the mag 7s that much more popular. Is this like there just isn't too many places to go where you're getting any participation, so it creates the crowding on even a global scale. But it seems like this has lost all upside momentum. It's obvious I can't say are the highs of the year in because there's only 2 more weeks left in the market. So odds are that the highs are in. But do you think that there's more room for the Nikkei to be to remain in bull trend, or is this going to be more of a market that will inevitably just stay correlated with all global equity markets?
I think Japan can do well. I'm bullish. I recognize that might take some time to work out. One of the most interesting things to me is that for a long time, if the yen went up, like it was just instantly bad for stocks. Like their interest rates climbing higher, like tended to weigh on stocks. And lately, like that has been breaking down a little bit. Where and obviously the yen stopped going up, but where that yen correlation was sort of softening up. So I'm
Yeah,
getting, and I think as you move forward, you go from uh, like them being hawkish and having a higher yen being a problem to actually being a good thing. It being a lot like the U.S. virtuous cycle of inflows into equities being also pushing the currency higher. I think they'll get there because they used to be a giant trade exporter. Now they're
yeah.
a net importer. Like I think it all makes sense. So I think you're going to get to the point where you have a weird feedback loop in Japan where you get a bunch of inflows that make everything go up.
I I am in the camp a little bit different, where I completely agree with yourself and Kevin, all on a larger time frame. So when we're looking at what will perform well over the next 2 to 5 year time frame, there is so much value here. There's so much opportunity, so much thing. My concern is that if we do enter a period where the froth out of this market is taken out, I don't think that this could be a place to hide. I think that there's going to be correlation on all global equities. And even though on a relative basis, like if you're doing a long short and you're going and you're carrying the yen, the Nikkei as the long, you probably will create an outperformance on that relative basis. But I don't think I would want to necessarily have the confidence to say that the Nikkei is going to be resilient and buck the trend or even move counter trend to when the global equity markets are all getting slammed. And so I do get your longer term thesis, and that I would love to participate in when the right technical setups are there for sure. But let's talk Europe. And this has been a dead market. And I'll tell you personally, because I actually now live in Europe and out in Lisbon here, and when I talk to any investors out here, they don't own the Euro stock; they own the S&P. Like nobody in from an average investor perspective actually cares about owning the European markets, other than major pensions and institutions and other people that own it just because they have to. I mean, this thing, while it had an epic run at the start of the year, has just been in a meat grinder with fake outs in every direction, and certainly had a little bit of an oversold bounce. But I'm in the camp that I think that these highs and the resistance will continue to be a huge obstacle for this index, and I'm not looking for the big breakout here.
Yeah, I could not agree more. And to your point, like in the UK, less than 5% of their pension money is even in UK stocks. So like in some of these countries, even their own pensions have all their money is overseas. So
yeah,
crazy.
That's crazy. And the last one, which I'm a little more bullish on, is actually the India market. So when you're looking at Bombay, India, you're looking at a market that actually tends to march to the beat of its own drum more than a lot of other global indices. And we obviously went through a pretty significant 2-3 month correction on the downside. That was a classic Fibonacci retrace to the downside, lasted, corrected the overbought conditions. And it's just creeping back above this 50-day like it wants to do a continuation pattern. And while I don't know if I have a macro bull thesis for India, technically, I'm curious as to whether or not India is about to re-engage another leg higher here. Are you bullish India or impartial on it?
I would say impartial. I haven't done anything about it, but I've been a little bearish lately. Like their currency and their inflation was becoming a problem. But I mean, you can see on the candle right now, like a nice retest of that moving average, and then kind of a new high. Like very impressive move. They got a nice soft inflation report that gives them some breathing room. So that is very helpful. So if they can keep that up, then I think you can get right back to, the very steady march higher they've been on.
I think, listen, it's just as simple as you can trade it just the way that the bull trend from June to September was sustained above its 50-day moving average. I think you can just technically trade this. It's like if this is showing bullish tendencies, holding support lines, being bought on dip, and perpetually crawling, it's worth seeing whether or not there's room to follow through on that. All right, Chase. Thank you so much for talking some charts with me here, buddy. So before I let you go, though, can you share with all of our listeners where they can follow you, where they can follow your work, and what you do, and give us the spiel.
Yeah. So as always, people can find me on Twitter at PineCone Macro, and now Blue Sky for like the 3 people that follow me there. Also, PineConeMacro.com. I started my own podcast recently called Tailor Made Macro that people might enjoy. I have a Substack but it's sort of a funnel into like the main research, but you can find that. You just Google it. And then I'm the head of research at Bulwark Capital. So it's another thing you can Google if you want someone else to help and you're in America and you want someone to look after your retirement or something. But yeah.
Awesome. Well, Chase, thank you so much for giving me your time and joining me. And I look forward to doing it in the future with you again, buddy.
Yeah, as always, I'll be standing by and ready to go.
All right. Thanks, bud. All right. Have a good one.
Take care.
Thanks again for tuning in into the Market Huddle. We appreciate you spending the time with us. Give us a follow on Twitter or X, what they call it, at the Market Huddle. And otherwise, Danny, let's get to this after show.
Let's try.
No, Kevin, but you know what? We're going to do fine. But so I'd love to rate this beer that I'm not drinking. But anyway, it was.
What about the air? What about the air that you're breathing? How would you rate that one? Is it nice?
Actually, you know, it's nice, crisp, fresh Portuguese air. That's perfect. But listen, I'm crossing the Atlantic, bud. This is it. Like by the time I'm doing another Huddle episode, I'll be back in Toronto. I'm gonna go there for the holidays. But it's not just that I'm going to see family. I'm going for the most important thing, which is every single year there's the traditional 12 pubs of Christmas pub crawl, and I'm not going to miss it. I'm not going to miss it. And we, you know, all our long-standing members or listeners know, you know, we posted it on Twitter or X before. It's the pictures of the pub crawl, but we do it in the same area of Toronto called the Roncy area, which is in the High Park area. And it's a 12 pubs that are all within walking distance. 1 pint in each pub. You have 30 minutes, 6 hours to do 12 pints. It's a shit show, bud.
I mean, it sounds like you would probably shit your pants maybe at the end. I mean, has anybody ever shit their pants at the end?
Listen, you're English. Tell me you've not done a pub crawl like this.
Yeah, I've done a pub crawl, but I mean, 12 is you know, that's quite impressive. I don't know whether impressive is the right word to use, but it's definitely something that, you know, not many people could do.
It is. It was originally inspired by a pub crawl, like a 12 pubs of Christmas pub crawl that was happening in Chelsea, down in London. By one of my good friends has his best friend out there, and they would send pictures, and it's like, why the hell do the British get to do this without us? And like, and so he said, we're doing it. And so, like, this is like the 7th year in a row that it's happening, and I mean, I've missed only one because I was on the other side of the thing. But I was like, I swear I'm not missing any more of these. And so I'm gonna fly back.
Kudos to you. I mean, I to be honest, maybe this is me being slightly naive, but I didn't actually realize that Canadians had pubs. I thought that was only an English thing. So that's where my lack of traveling has maybe let me down.
Oh, come on. Canada's just like a colony of England. So whatever's in England is in Canada in some degree or another. Just a little bit of American flavor to it.
That's unfortunate for everybody, I think, involved.
All right. And what are you doing for the holidays? You going to go anywhere?
Well, I'm probably going to stay here in Portugal. I'm probably going to enjoy some lovely Portuguese wine, maybe.
Oh, wow.
Yeah. And I'm going to try.
No, it's actually good wine.
Yeah,
I like it.
Yeah, good. And then, yeah, you know, we're gonna see what our first Christmas in Portugal will be like, and missing home for sure. It would be nice to go home, but to see what the Portuguese have to say about Christmas.
Oh, there you go.
Yeah.
All right. Well, let's call it a wrap here. To all our listeners, obviously we'll have a live event, but I think actually we will still have one more show before Christmas, so I'm not going to bother to wish everyone a holiday yet. We'll have still some episodes there. But anyway, let's see how everything plays out in the next couple of weeks. Thanks everyone for tuning in.